Welcome back to Factful Finance, where we turn money myths into financial triumphs. Today, we're diving deep into something that might just blow your mind: the biggest money myths keeping you broke. And we're on part 7, so if you've been following along, you already know we've been uncovering some game-changing truths. If not, no worries. You're in for a treat. Have you ever felt like you're stuck in a financial rut, no matter how hard you work or how much you save? You're not alone. And guess what? Many of the myths we believe about money might actually be keeping us from breaking free. But don't worry, I'm here to bust those myths wide open. Here's one for you. I'll start saving more once I make more money. Sounds familiar, right? Many people believe that income is the key to financial freedom. But let me hit you with a reality check. It's not about how much you make, but how much you keep. Studies show that 78% of Americans live paycheck to paycheck, even though they earn a decent income. So, what's really holding them back? It's all about mindset and strategy. Sure, making more money is important, but unless you know how to manage and invest that money, it won't get you very far. This myth keeps people in a cycle of spending, making it harder to build long-term wealth. Take Noah, for example. Noah was making 6 figures as a software developer, but his savings account barely grew. Why? He believed the myth that once he reached a higher income, he could start saving. But without the right strategy in place, he kept spending on things he didn't need, like the latest tech gadgets and a bigger car. It wasn't until Noah started prioritizing his savings first, paying himself before paying bills, that he began to see real growth. And here's a shocking stat. According to the Federal Reserve, nearly 40% of Americans don't have $400 saved for an emergency. It's not because they don't make enough, but because they haven't adopted the right financial habits. The real key is understanding the importance of budgeting, building an emergency fund, and putting money into investments that will grow over time. It's not about your paycheck, it's about your habits. But let's talk about another myth that's doing a lot of damage. I don't need to worry about my credit score until I need a loan. This is a dangerous myth, and it could cost you. Credit scores affect much more than just loans. Insurance premiums, renting an apartment, even your job prospects can be impacted by your credit score. Take Amelia, for example. She didn't care much about her credit score until she applied for a car loan. By then, her credit score was in the low 600s, and she ended up paying double in interest compared to someone with a higher score. The lesson? Don't wait until you need credit to start worrying about it. Your score is a reflection of how well you manage debt, and it impacts so many areas of your financial life. Then there's the myth of debt is bad. Many people believe that any form of debt is something to avoid at all costs. But that's simply not true. Debt can be a useful tool, especially if it's helping you leverage an investment that will appreciate over time. For instance, student loans or a mortgage for a property that grows in value can be considered good debt. The key is to manage it wisely. Henry, for instance, bought his first home with a mortgage he could afford, and over time, the value of his property grew. He didn't let the myth of debt is bad stop him from investing in a growing asset. By making smart decisions about how much debt to take on and using it for investments, he was able to build wealth instead of being weighed down by it. The truth is, understanding debt, credit, and saving is crucial to building wealth. But it's not always easy to know where to start. Here's a tip. Start by tracking your spending. Many people are unaware of where their money goes until they see it laid out in front of them. That's where budgeting comes in. Want a real game changer? Automate your savings. This simple strategy ensures you pay yourself first. Set up automatic transfers into your savings and investment accounts so you're consistently growing your wealth without even thinking about it. Lastly, let's tackle the myth of I'm too young to start investing. Whether you're 22 or 62, the best time to start investing is right now. Compound interest is your best friend. It works wonders when you start early. Even small amounts, invested consistently over time, can lead to huge growth. Think of it like planting a tree. The earlier you plant it, the bigger the shade you'll get in the future. Olivia, a 24-year-old marketing professional, decided to start investing $200 a month into a diversified index fund. Fast forward 10 years, and her investments have grown substantially. The earlier you start, the more time your money has to work for you. Now, I know this can feel overwhelming, but trust me, it doesn't have to be. Financial literacy is all about breaking down these myths and creating a strategy that works for you. Remember, the road to financial freedom is not paved with myths. It's paved with smart decisions, discipline, and a little bit of patience. If any of these myths hit home for you, drop a comment below and let me know your biggest financial challenge. I'm here to help, and I'll respond to as many as I can. And if you found this video helpful, don't forget to hit like and subscribe. There's a lot more where this came from. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Ready to bust more money myths? Trust me, you'll want to catch the next video. It's coming soon, and I promise it's one you won't want to miss.